Mohammed, welcome back to the Millennial Money Canada podcast.
Thanks for having me. Love to be back. I love your podcast. I listen to every episode, so excited to be back.
Sam, do you want to talk about the big news and the big announcement?
Yeah, so really excited to announce that Copilot Tax, Mohammed and Shafi, and Millen Wealth Advisors are going to be working together to better serve our clients in a partnership arrangement so that we can really have dedicated access to expert tax advice from you guys. So I'm really excited about that. We've kind of been back and forth about this for the last 2 months and testing it out a little bit, sending clients your way, and everyone's just had a positive experience. And just your breadth of knowledge and expertise on tax, and how you're also active on social media. You work with the same type of clients that we work with, and we kind of talked earlier too about how when we encounter like different scenarios, they're often like the same scenarios. Like I'm looking at a client situation and you're looking at a client situation, we can kind of identify like the same problems, and they're coming up over and over again. And so when we work together on that, it brings a different level of expertise to the table for clients. So I'm really excited about this this partnership and how it could work out for the long term. So welcome to the team, and I guess vice versa here too. But would love to hear your thoughts a little bit, Mohammed, too, on like the journey to getting here, and also like why you feel like this is a good partnership for both of us.
Yeah, I think there's a lot of synergies our clients can really take advantage of. I think just one thing is referrals. Like we work on very similar clients, and so Sam and Guillaume may have really good lawyers that they work with, and we have really good lawyers in other areas. And so sharing that information, leading clients to the same referrals, and even just kind of bringing the best results for clients. So we do have clients who don't have financial planners, and we do have clients that do have financial planners. And we find that there's a really big difference in the results and the financial success of those clients with financial planners. And so taking making sure you have kind of that unified team to kind of help address all the issues and bring you the best results. Like we see it firsthand, and it's definitely amazing that we get to partner with such a great team. You guys do a really good job, put out a lot of good knowledge. I've learned a lot from your podcast and just a lot of your social media posts as well. So, very excited about this partnership altogether.
Yeah, vice versa. I mean, like the amount of knowledge, you guys and your visuals. I love your visuals, and I'm excited to share them with clients. And I think we're going to go through that here a little bit today in one of the topics that we're going to discuss. But just the way that you break down information, like really complex information around CRA and taxes and all that stuff, and gives the clients the ability to actually understand. You've got like these flow charts and all of that stuff on how to make decisions on different things. I think it's really cool the way you communicate and the knowledge that you guys have on the tax side. And the way I look at it too is when we're working in silos with clients, like we're here giving advice, and then there are accountants over there giving advice, and there are lawyers over here giving advice, and whatever other professional advisors they have. At the end of the day, all of us are going to be giving different advice. And if there isn't a synergy of, hey, we're talking to the accountants, we're talking to the lawyers, and actually having that team that works in the client's best interest, what happens is there's fragments that all these different fragments of advice leads to a bunch of confusion for the clients, leads to poor decision making, and ultimately delays of implementation of things too. So I think having this team approach can really work very well for our clients.
Exactly.
And we're going to have a dedicated episode just on the partnership, but we're going to have Shafi as well on. So stay tuned for that. And we can talk about, in more detail as to like what is that's going to look like, for you, the end client, while you're coming through, working through us, Millen Wealth Advisors, and how you're going to be introduced to Copilot and vice versa. But today, the topic is around real estate and was inspired by one of Mohammed's graphics. I'm not sure if you've posted. I think you have yet to post it on social media, if I'm correct, right? So This is breaking news, guys. You have the audio part before you get to see the visual part. But Yeah, this graphic was around, basically it was 3 parts. Was buying real estate, and then into like when you're buying real estate, renting, and then when you're selling it, and all the tax considerations that you should be aware of, or maybe that people often missed in each of these 3 buckets. So with that being said, I want to turn it over to Mohammed. Like, what prompted you to, even come up with that visual and try to summarize everything that has to do with tax and real estate in kind of one slide? What was the inspiration behind this?
Yeah, I guess what I noticed is two big things. Number one, I see a lot of questions online about real estate. What happens when I sell my rental property, or I'm thinking of moving out my rental property, or moving in or renting out my existing property, or like all these different tax questions with real estate. And, and like the reality is real estate has been such a common investment for a lot of Canadians. And there are so many tax issues with it that people don't think about. When you're dealing with something like a TFSA or RSP, you don't really have to think about the tax as much, because once it's in there, there's no real tax. Like you don't really have to think too much about the taxes. But when you have a rental property, there's taxes each year, and you have to report that income each year. And so there's a lot of the things that happen, and there's so much variability. There's different types of real estate investments, and there's not a lot of good knowledge out there. And it's not like, and I don't want to blame, the accountants or the financial planners for not putting a lot of content out there. It's just that there's so much to talk about that it's hard to grasp all this information. So what I really was trying to do with this visual is I was trying to list out all the potential issues at each stage of real estate, whether you're buying, whether you're renting it out, or whether you're selling, so that the common person can really look into these issues and find out, hey, could this potentially be an issue for me? Could this be an issue for me? Do I have to look into this? And so that they can, avoid making big tax mistakes.
Yeah.
Makes sense.
I'm looking at the visual here that you shared that I'm sure you're going to share shortly on social media, and just kind of the 3 different components of owning real estate. I mean, like, I'm just thinking back to my own experience of buying my first house, and all the different things I had to think about in the context of, well, where am I going to get the down payment from? What mechanisms can I use? And then, like, with a principal residence, it's fairly simple, because again, it's kind of the similar analogy made to the TFSA and RSP, where it's like, once you buy it, as long as you don't use it for income, like rental income, then like the proceeds of the sale are tax free. But just even the idea of buying rental properties as an asset, so many Canadians do it, as you mentioned. And because with Canadians, so much of their wealth is in their primary residence, I think often, like, we confuse the tax treatment of principal residence with how rental properties are. And it's so different in everything from how you qualify to how you report gains to what the, claiming depreciation, selling, adjusted cost base versus the market value, like all of that stuff, all of that can be affected intra-year by how you claim certain things. And so it does create a whole level of complexity around it that, again, I just don't think the average Canadian who owns a rental property thinks about or wants to think about, to be honest, right?
Yeah.
So I think the graphic is really, really cool. I'd love for you to dive more into just like maybe that first stage of you're interested in buying a home, you've got a rental property in your sights, kind of like what that first stage looks like.
Got it. So I think one thing before just diving into it, I want to clarify is that this doesn't apply for all types of real estate investments. I'm just trying to capture as many potential issues irrespective of the investment. So, for instance, if you were to buy a commercial property versus a residential property, certain things here might apply to you, certain things might not, right? So I was just trying to do an all for one kind of graphic. But I think that's the first thing you need to understand. What kind of what kind of real estate are you investing in? Is it like a residential property? Is it a short-term rental? Are you flipping properties? I think that's number one. And then once you kind of figure out what kind of investment you're making, then you can look at the potential issues, right? So number one, are you buying this to rent out? Are you buying this to flip? Purpose will determine a lot of things, because if the purpose of your property is just to hold it short term for appreciation, then what you may actually have is you may not have a capital gain when you sell. You may actually have business income. And then you also have the potential flipping property rules that could apply if you sell it within, 1 year. So I think number one, you need to understand what kind of investment you're buying and what the purpose of the investment is. And then with that, you have a whole bunch of issues, right? So number one, you have a whole bunch of acquisition costs when you're buying, right? So you're paying a lawyer, you're paying potential land transfer tax or property tax. And so if you're not mindful of all these things, then you may, you may not understand what happens to these expenses. A lot of people, they buy these rental properties, they think, hey, I'll just expense all of these things, but you really can't. You have to actually capitalize that and depreciate it over time, and then depreciation's a whole nother monster to think about. I think how you're gonna pay for the property, and I know you guys have put out some really good information on this, specifically using your registered accounts. I think this is probably one of the biggest areas you could see tax savings. People buy a lot of properties without thinking about any of their accounts, RSPs, first home savings accounts, and where a down payment was probably $100,000 of their own money after tax. It could have been much less if they just took advantage of certain kind of accounts and tax strategies. And this is something I also want to ask you guys. Do you guys see that a lot with people buying properties, not making use of their accounts, or being unaware of certain strategies?
Yeah, like I had a interesting experience recently, and so I wouldn't say a lot, especially because like prior to 2020, I think it was 2022 when the FHSA got rolled out. Prior to that, there was only the RSP home buyers plan, and there's a lot of information around that online. But there were still people who hadn't used their RSP home buyers plan and did actually withdraw money from their RSPs. But now with the introduction of FHSAs, I think there's a little bit more confusion on which is the optimal one to use, which one do I fund first or draw from first in that context. Um, yeah, so we have seen people not take advantage of it when they should have. And we've seen it cost them tens of thousands of dollars in taxes to do so, pulling money directly out of their RSPs, paying the withholding tax of 30%, which actually ends up being more than 30% because at the end of the year, they've got to claim it on their income. And if they're making 100,000+ a year, then they're in the 43% marginal tax rate or higher. So like those are all considerations that, again, people without advice. And when I used to run my home buyer seminars, I used to do like a with advice and without advice comparison screen. And it's like with advice, they're using the home buyer's plan properly. They're claiming the proper deductions. They're doing all of these things. And then without advice, either they don't use RSPs at all, or they use RSPs and take it out and pay a bunch of taxes. And now you can even compound that with FHSAs, but it's thousands of dollars in differences. And we have seen the odd client who just comes to us and was like, I had no clue that this was actually available to me, and I had no advice around it, and paid way too much in tax.
Yeah, it's incredible the savings that you can, take advantage of with just a little bit of planning. And, you know, a lot of people I come across, a lot of new clients or potential people I talk to, they do have plans to buy homes, and they're not thinking ahead. They're not thinking about, should I open my FHSA now? To build the contribution room at least, because you need to open the account to build the contribution room. And there could be huge savings when you buy a home,
Mhm.
i- yeah, in those situations, right? Or people who never even plan to buy a home and could open those
Yeah.
accounts.
They can still open those accounts, right? Like you can plan to be a forever renter and still take advantage of the FHSA and RSP. And I'm curious because I know this was a loophole when the FHSA first opened, and I'm not sure if they've closed this yet. I don't think they have. But for like lifelong renters, because you can tax defer transfer your FHSA to your RSP after that 15-year time frame. So like you put the maximum in, I think it's $45,000, the maximum you can put in an FHSA over 5 years. Is that number correct? 45,000?
48,
40, sorry,
8,000 a year.
40,000. Yeah, go figure. I need to brush up on this. But 40,000 you can put in over 5 years. And then let's say over the course of 15 years, that doubles to $80,000. This is a lifelong renter. And in the meantime, they've actually maxed out their RSP. Now, initially, there was a loophole that they could actually transfer that money to their RSP and it would not take up contribution room, meaning that it's kind of like an extra contribution to your RSP. There's no initial tax deduction, but it's more money being tax sheltered than what you actually had room to do. I don't think they've closed that loophole. I think it still exists. Correct me if I'm wrong on that, but it's a way to kind of supercharge an RRSP if you're a lifelong renter and want to take advantage of the FHSA.
Yep, exactly. And that's like a great strategy, right? To kind of just get more deductions, get more RSP room that you wouldn't have otherwise had. So, one of the biggest issues I see when I get, new tax returns from, other firms or people doing it themselves is something called a land building split. So, a lot of times when people buy a rental property, you don't really realize it, but you're buying two different assets. You're buying land and you're buying building, right? And this is important because for tax purposes, you can't depreciate land, but you can depreciate building. So if you were depreciating, let's just say it's 4% a year on $1 million property, and your land makes up, let's just say 50% of the value of your home, you might have been, claiming 2% more or 50% more depreciation than you were allowed to claim because you were claiming depreciation on the land, which you weren't allowed. And a lot of people miss this, and accountants included, right? Like, this is probably one of the biggest things I see, biggest issues I see when I get clients that have rental properties. There was no land building split done when they purchased the property.
So just a point of clarification on there, just in case people don't know what depreciation is, basically like if every asset that you own has like a certain class or category it's in, which the CRA allows you to kind of basically on paper mark down its value and claim a corresponding deduction of that, if I understand that correctly. So if you have $1 million property that is depreciable outside of the land and you're in the 4% depreciation class, then you could claim $40,000 of deductions against income generated from that property, or income in general, from my understanding. Or is it just income generated from that property?
It's, yeah, income generated from that property or other rental properties.
But there's a kind of a catch to it, right? Because like when you sell the property, then you sell it at its fair market value. And when you depreciate a property, its value on paper is deemed to be lower, less and less and less. And so you actually end up paying a larger capital gain on that, right? So depreciation is simply just like lowering the value of an asset on paper to claim tax deductions. So just in case, I just wanted to clarify that. And if you have any additional clarifications on there, just in case I missed something on depreciation, I think sometimes people don't even know that they can actually depreciate their rental properties.
Yeah, exactly. And I think that brings us to kind of the second stage where I see the biggest issues, and that's during the period of renting out the property, is whether you should or shouldn't claim depreciation. I think, Sam, you kind of hit the nail on the head that a lot of people don't realize that you actually have to pay that back in the form of recapture when you sell that property, or you get taxed on that income again once you sell that property, assuming it's, being sold for more than its depreciated value. And that brings a lot of questions. Should you or should you not claim depreciation if you're eventually going to, be taxed on that same depreciation that you took? And I think this brings up tax deferral, right? So you can defer tax by claiming depreciation, right? You reduce your rental income today, but when you sell the property, you will, be taxed on it. And tax deferral generally is a good thing, right? You can defer tax, which means you don't have to pay tax now, which means you can invest that money you would have otherwise paid in tax and earn a return on it. But when the tax differential is so much, then it may not actually make sense to do it. And let's just say, you're making, your tax rate right now is about 25%, and you're unsure whether to claim depreciation. You won't know what your tax rate is you won't know what your tax rate is unless you're working with a financial planner who does a good financial plan for you. And so whether you should claim depreciation or not, a lot of people ask their accountants. I actually think this is something they should ask financial planners. And this is like exactly why I see the value in the financial planner and in this kind of partnership so much. If a financial planner can model this out for you, they can actually tell you whether claiming depreciation is beneficial or not. Whereas we're it's just a guess. We have to use rule of thumbs. We have to, like, we don't actually have and I say I mean us accountants, we don't actually have the knowledge to tell you whether it's beneficial for you to do that or not. And so I think a lot of times people think they have, questions for accountants, but they're actually questions for financial planners that you should actually ask a financial planner.
Sorry, just to confirm here. So when the more depreciation that you claim, the lower that you're reducing the taxable rental income today, and the greater the capital gains you're building in the future when you're selling. Is that correct?
Almost, it's not
Uh,
capital gains. So because you're writing off rent one for one,
yeah.
you're going to be taxed as almost regular income, right? It's not a capital
Oh,
gain because they don't want you to, when you sell it, they don't want you to be taxed on
Yeah.
half of it, which a capital gain is taxed on
yeah.
half of it. They
Hmm.
want you to be taxed on the full amount, right? And so you actually have to pay back tax at the full amount when you do sell it.
And
Hmm.
that's just on the recapture portion
Yeah.
though, correct?
Yeah.
Because the recapture will bring it. So there's like the recapture of capital cost, or the recapture of capital costs, I think is what it's called. So basically, it'll bring it back up to its original adjusted cost base. And then the difference between its original adjusted cost base and this fair market value that you sell it at will be a capital gain, but its recapture will be taxed fully as like included in your income, if I understand that correctly. And the crazy thing too, okay, so interesting you mentioned the financial planner side of modeling that out, because I feel like when we're doing projections, we can model out what a client's net worth is likely to look like and the life cycle of their asset that they're buying, right? So if we know that this rental property is going to be sold at retirement, right? Because they don't want to be landlords when they get into retirement. And let's say they're 10 years out. Well, we can actually look and estimate what their taxable income is going to look like with some level of certainty. Obviously, not guaranteed that it's going to be that because we don't know what the rest of their investments are going to actually do. But we can kind of model out and say, okay, this is likely what your taxable assets look like. This is likely what your taxable income looks like. We can turn on and off taps. And so basically, and this is a kind of, again, why I see a partnership with this working so well, because we can model this out and basically send those reports to you now and say, hey, Mohammed, this is what we're thinking. We want to turn the tap, we want to delay turning the RSP tap on until after the year after they sell their property. And that way, we're not including too much taxable income in year one when they sell. And we just want to make sure like this works. And then you've got all the data to actually say, yes, this is the right decision. So kind of in tandem there, when we're working together, I feel like we can actually make much better and more informed decisions on that.
Yeah, exactly. Accountants can really only model taxes for 1 year. Like our software only lets us do it 1 or 2 years, whereas financial planners can actually model a lifetime of taxes. And so that's an incredible tool to think about when, timing RSP deductions, depreciation, things that require more long-term tax planning. It, they're very equipped to do that. And that's why it really makes sense for accountants and financial planners to work tandem, and why this partnership, I think, is going to work so well.
So, quiz question here for you guys. If you can't depreciate land and you can only depreciate building, where's the value in real estate? Is it in the land or is it in the building?
It's a good question. And there actually are some tax implications for that, like the very complicated things for that. But that's a good question. Where is the value in the land, or is the value in the building? A lot of people will argue a lot of the values in the land, right? Because the buildings actually depreciate in value, whereas land, it's finite, and you can't build more of it. But I guess, what do you think?
I agree 100% with the answer you just provided. And I think that's a big misconception where I think people miss where, because appreciation, if you don't put money, if you don't have cash outlay to maintain it, to maintain its value, it's actually going down over time. Why? Just wear and tear. But especially if you look like a market like Victoria, we're landlocked. I mean, those $1 million houses, like, dude, you wouldn't even pay 100 grand for them, but just because where they're located and the size of the land, I mean, their value has risen and risen because just there's no land available. So yeah, I think people sometimes they misplace where the value is in real estate. Yeah.
Yeah, this kind of like brings parallels back too to when I was working in Saskatchewan, and living in Saskatchewan and kind of starting my practice. We worked with a lot of farmers, and like the actual land that all the farmers own versus the buildings that they owned, right? And how you treat them differently from a corporate structure perspective, and how um, you'd put one section in the corp, and then land usually would be outside of the corporation, and those types of things. It goes to kind of, yeah, like I don't know if I've necessarily thought about it in the way that like land and buildings are inherently separate, and if you don't take care of the buildings, obviously you're going to lose value there. But the land in and of itself maintains its value in that aspect, at least from a tax perspective, it does. I think if people thought about that a little bit more, we might, I think there maybe would be some better outcomes in some of these rental property situations as well, because they're thinking about it from a different perspective. But like in maintaining the property, um, I've sent people your way who haven't claimed interest deduction costs on their rental property mortgages, right? We've looked at different scenarios of what the tax advantages could look like when they actually own the property, depending on the type, right? And if it's business or personal, but like personal rentals and things like that. Looked at, people always have questions for us, like, should we hold our rental property in a corporation versus personal? I know there's so many different questions about the setup and then the ongoing maintenance side of it. Would love to kind of hear your thoughts on some of them. Again, rules of thumb. I don't love rules of thumb, but like kind of some of the more successful structures you've seen. Like, when should people hold stuff in corporations? When should they hold it personally? And what are some of the tax implications that they can claim and should be aware of when they're maintaining the property after they bought it?
Yeah, I think a lot of some of the big rule of thumbs are, if you ever kind of see yourself moving into the property, you may not want to claim depreciation because, whenever there's a change of use, it's like you're selling it and buying it again. So if the property is appreciated, you'll pay all this tax on it. There is an election to avoid that, but in order to make that election, you wouldn't have been able to kind of have claimed depreciation in the past. So I think this one of the other things that really gets missed in the depreciation discussion, if you ever see a future of moving into that property. I think in terms of structuring, generally it's not a good idea to hold it in a corporation, because when a corporation earns rental income and then pays it out as a dividend, you face like a very high amount of tax, assuming you're at the highest tax rate, something like 58%, I think, or 56, 7%, around
Like
that range.
combined tax rate, personal and corporate.
Exactly. Yeah,
Mhm.
when you earn the rental income and then pay it out as a dividend. Um, so I don't generally like that strategy. Now, there are very unique times where it could make sense, but those are very, unique situations. I think one of the common ones really is if you already have a business that earns, an incorporated business earning business income, and you want to invest that and you want to invest it in real estate, then it would make sense to kind of invest through real estate in your corporation, because then you have, after tax dollars, which are taxed at a very low rate, and you can use that to invest in the real estate, as opposed to paying it out to yourself, paying those very high tax rates, being left with even less, and then investing in real estate at that point. So those are the situations where it does make sense. And I think a lot of times we focus on just the tax, and I think we miss, the legal aspects of things. And owning a rental property personally, at least in Ontario, owning a rental property personally versus in a corporation has very different implications of what you can do. Like, if you own it personally, you're actually able to kind of tell get the tenants to leave and move into the property. But if you own it as a corporation, even if you want to live in the property, you can't get your tenants to leave. So there's also legal ramifications you need to be mindful of. And that actually happened to one of my clients, except he was the tenant, and he stayed because he searched up this loophole and figured that out, and he was able to get his
Interesting.
landlord not to move in and kick him out.
So I think too with the legal side, and we're not lawyers here, obviously, so I always make sure to get like competent legal advice on all of this. But with there is, I've heard an argument made from a liability perspective that corporations could make sense. So for example, like if someone is in the highest marginal tax rate personally and they want to start a rental property portfolio, so they're going to like buy 2 or 3 or 4 over the next 10 years. From like a personal liability perspective, obviously there's like home insurance and that type of stuff, which can cover some of that. But in terms of tenants suing you and those types of things, if it's in a corporation because that's a separate legal entity, they may not have as much claim over personal assets or other business assets that you own. I don't know if you've heard that argument before, if that argument holds weight. Again, like we're not lawyers here, but that's something I've heard as a reason to, potentially look at moving either existing rentals to a corporation or buying your first property as like in a holding company or something like that.
Exactly. Yes, liability is a huge consideration. I think when we talk about liability, people love bringing up corporations, but there could be more cost-effective measures, right? Like I think, uh, like insolvency insurance, or I don't know all the different types of insurance that are available. And there is also risk of them piercing the corporate veil, meaning they look through the corporation. But in general, it is an added protection, and so I do like if that is a big concern, and then especially if you're gonna have quite a few rental properties, then it probably does make sense at that point.
What do you advise someone who has a business, has the intention to sell their business, and let's say they're accumulating retained earnings? Would you still advise them to, like, how would you advise them if they want to invest in a rental property, for example, and let's assume it's their first one? Would you advise them to, dividend out and then buy it personally? Would you, transfer, the retained earnings to maybe a holding company and then buy it through their holding company? What's one of the advice you would give to someone like in this scenario?
Yeah, I think it depends on the facts. So sometimes, depending on the type of corporation, they can have a holding company above it and they can't. So professional corporations are a lot more restricted in that sense. But if they can, yes, that would be great, because then, if anyone sues the business, they can't go after the real estate. But if someone sues like if a tenant sues you, they could still go after the business because the business owns some of the shares of the holding company would own some of the shares of the business. So I think that's an important thing. The liability is usually one way; it's not both ways. And it's also really good, especially if you have plans to sell your business, because you could be exempt from some of the gain when you sell it through the lifetime capital gains exemption. If you kind of don't have a lot of passive assets in your business corporation, and so using a holding company would be very effective in that manner to make sure you're eligible for some of that exemption, if you do sell your business in the future.
Something I want to go back to on the purchase, because I wonder if I don't want this to get like misunderstood. When we're talking about buying rental properties, um, typically the programs available for buying your first home, like the RSP home buyers plan and the first home savings account, you wouldn't necessarily qualify if you're buying a rental property that you don't intend to occupy, right? So, like, for example, if your first home purchase is going to be a completely independent rental unit that you're not intending to occupy at all, typically those programs wouldn't qualify you for a withdrawal of those assets. But what we often see, and I think there's been like some reporting on this, like I guess Warren Buffett still owns the first ever home he bought or something like that, or like some of these big moguls still own the first home they bought. They're just like rental properties now. I think what we tend to see, especially in Canada, is like maybe more so 10 years ago than now, is like the idea of starter homes becoming rental properties. So if you're looking at a home for, like, I guess a starter home now, probably in most major centers would be upwards of $500,000 or $600,000. But like you're looking at something like that, okay, this is our first home, we're going to move into it, and then in 5 years, which is kind of the typical life cycle of your first purchase, is we're going to move out of this and into something bigger. Our family's growing, what have you. And then the decision becomes, do I rent this out or do I sell it? And oftentimes, if you're in a really good financial position, you can, you don't need the liquidity of selling that property. You can then rent that out and then kind of transition your first home into a rental. So that still does work in terms of like accessing the first home savings accounts and RSPs. But if you're like trying to just get into the rental market, and you've never owned before and you're not going to live in the home that you're renting out, it'll be unlikely you'd be able to have access to the RSP home buyers plan and the first home savings account.
Exactly. That's kind of what I see on my end. So usually when someone has these programs available to them, they're not thinking about the rental property first off. They're usually thinking about it for their own home. And in the future, they may want to upgrade. And when they upgrade, then it's like you've taken advantage of these accounts. And then if you want to put that like, property to rent, which is typically one of the common things I do see, then it's like really like you've taken advantage of these accounts for the purpose of a rental property. So exactly, it can only be used for a personal property, but people usually end up renting out their personal properties if they do upgrade.
Looks like we're coming up to the time limit here, guys. Any last comments before we close out this episode on a few tax considerations, important tax considerations when you're buying, renting, or selling real estate? And I'm sure more will be added in the upcoming episodes because there's so much to cover on this topic.
Yeah, I think just making sure you're speaking with, qualified financial planner or accountant whenever you're dealing with rental properties, because there's so many hidden traps here. And without good advice, you could be making kind of a big mistake.
Sweet.
Amazing. Thanks
Awesome.
for your insights as always, Mohammed. I'm really looking forward to this partnership, how it's going to benefit clients, and how we can work together on these things. So thank you to you and Shafi for agreeing to work with us, and I'm excited for what the future holds.
No worries. Excited for you guys agreeing too, and looking forward to it.
Awesome. Stay tuned, listeners, for the upcoming episodes we have lined up. Some very interesting topics over the next several weeks. So yeah, super excited to have Mohammed, CPAs on the podcast with CFAs, with CFPs. So we're just expanding the knowledge crew here, which is awesome. So thank you guys. Thank you for listening, and we'll see you in the next episode.